All right, let's dive right into this fascinating explainer. Today, we're bridging the gap between our internal psychology and the very future of global innovation. We're going to look at how the exact same mental frameworks that make individual investors successful can actually be scaled up to finance some of the most complex, world-changing technologies on Earth. And look, the stakes here, they literally couldn't be higher. We aren't just talking about, making a quick return on a portfolio. We are talking about whether or not humanity has the right psychological operating system to fund the technologies that are going to save our planet.
To really understand successful investing, we have to start with this brilliant observation from Charlie Munger. It's such a powerful reminder that accumulating data just isn't the same thing as accumulating wisdom. I mean, you could read every single financial report in the world, but without mental models, what he calls a structured latticework of theory, your facts are completely useless when the market gets chaotic. Your brain absolutely needs a reliable architecture to hang those facts on. Otherwise, the noise is just going to overwhelm you.
And that brings us to a really fundamental question about how our brains process risk and opportunity. Think back for a second to the sudden market crash of March 2020. When the market dips that violently, why do some people aggressively sell at the absolute bottom, while others confidently step in and buy the dip? The answer to that doesn't lie in their spreadsheets or their fancy algorithms. It lies entirely in their psychology.
So here's our roadmap for the explainer today. First, the psychology of risk. Second, Buffett's mental models. Third, growth versus fixed mindsets. Fourth, the deep tech paradox. And finally, a new investor archetype. We are taking a journey from micro-level human psychology all the way up to macro-level venture capital.
Okay, Section 1, the psychology of risk. Let's look at understanding your internal investor traits. Before you can ever properly evaluate a business, you've got to accurately evaluate yourself.
Research from the group Data Points identifies 5 stable traits that make up your investor personality. We've got risk personality, risk preference, volatility composure, investor confidence, and investor judgment. Now, these aren't just temporary moods based on, what you had for breakfast. These are your hardwired defaults. They dictate whether you're going to panic or prosper. And I want you to pay special attention to the gap between your confidence and your composure, because that specific gap, that is where the real danger lies.
Honestly, ask yourself right now, how do you emotionally handle sudden declines in the market? When you open your portfolio and just see a sea of red, what is your immediate physiological reaction? Do your palms sweat? Does your heart start racing? Do you feel this overwhelming urge to just sell everything and make the pain stop?
Here is the crucial takeaway. Investors who have really high confidence but low volatility composure are the most vulnerable to disastrous emotional decisions. Their overconfidence makes them entirely blind to the cliff's edge. They think they're absolute master investors during a massive bull market, but the moment things get rocky, that lack of composure leads them right into cognitive traps. They experience loss aversion, where the pain of losing money feels twice as intense as the joy of making it. And that panic, it leads them to just follow the herd right off a cliff.
Which brings us to Section 2, Buffett's mental models, our tools for rational decision-making. To protect ourselves from those nasty emotional biases, we can borrow the cognitive frameworks of Warren Buffett. Because his success isn't about having a higher IQ, it's about having superior operating system.
One of his absolute favorite tools is the margin of safety. He inherited this from his mentor, Benjamin Graham, and it acts like a psychological shield. By demanding a margin of safety, which basically means buying an asset for significantly less than its calculated intrinsic value, you completely remove the pressure of trying to perfectly time the market. It physically lowers your anxiety. Why? Because you know you have a built-in cushion if your analysis is slightly off, or if bad luck just randomly strikes the economy.
Another incredibly powerful framework is inversion. As humans, we naturally ask, how can I succeed? We're always looking for the absolute best-case scenario. But instead of trying to be a genius, Buffett focuses heavily on consistently avoiding stupidness. By flipping the question and asking, what would cause us to fail? You instantly spot the blind spots, the over-optimistic projections, and all that excessive hype that ends up ruining most portfolios.
So if you follow his precise toolkit, investing transforms from this anxiety-inducing gamble into a highly repeatable logical system. First, stay strictly inside your circle of competence. Only invest in what you truly understand. Second, seek out businesses with widening economic moats, those durable competitive advantages. Third, practice extreme patience. Only swing your bat when you get that absolute perfect fat pitch. Fourth, run every decision through a rigorous checklist to strip out the emotional noise.
And finally, evaluate everything in terms of multi-decade compounding. This framework just entirely removes the mental fatigue of constant daily decision-making.
All right, Section 3, growth versus fixed mindsets. Let's see how these dueling mindsets dictate how we react to failure and success. You've probably heard these terms coined by psychologist Dr. Carol Dweck, but applying them directly to financial markets reveals some really fascinating contradictions. Normally, a growth mindset offers incredible resilience. It makes an investor highly flexible. If a thesis turns out wrong, a growth-oriented investor will adapt, pivot, and view the loss as, basically a necessary tuition fee for learning. Conversely, a fixed mindset is almost always portrayed as entirely negative. It supposedly limits you, makes you fear uncertainty, and causes you to stubbornly resist adapting. But in investing, context is literally everything.
Paradoxically, and the financial group DBS points this out beautifully, a fixed mindset can actually be a massive superpower in investing. It keeps you fiercely focused. Think about speculative manias, like the frenzy over meme stocks or untested cryptos. An investor with a growth mindset might feel compelled to jump in, wanting to learn and diversify. But a fixed mindset investor, they stay naturally skeptical of the hype. It acts a whole lot like Buffett's circle of competence, keeping you safe from reckless gambling and allowing for lightning-fast decision-making within your specific, narrow niche of expertise. Moving on to Section 4, the deep tech paradox. We're looking at financing the fourth wave of innovation. Let's zoom out from the individual investor to the global macroeconomic landscape. We're going to take these exact same concepts of risk, competencies, and mindsets and apply them to the most critical frontier of human progress.
Just look at the explosion in funding for this sector. It skyrocketed from $15 billion in 2016 to a staggering $60 billion in 2020. That is a massive 4x jump in just 4 short years. Global investors clearly know there's a colossal wave of innovation coming. But as we're about to see, simply throwing mountains of cash at it, it isn't enough if the underlying psychological mindset is wrong.
So what is deep tech? It's a shift from purely digital software to complex physical solutions. We aren't just talking about writing code for a new social media app anymore. We're talking about synthesizing biology, building quantum computers, engineering advanced materials. It's the monumental convergence of the digital and the physical world, bits and atoms working together in real space to solve massive, tangible global problems.
But here is where we hit a massive wall. We're facing a paradox where traditional venture capital funds simply lack the expertise and the time horizons required for deep science. Most VCs today are built entirely on the digital software model. They want high market risk, meaning they don't know if people will buy the app, but very low technology risk, meaning the app is cheap and easy to build. And they want their massive return in 5 to 7 years. Deep tech requires the exact opposite. You have huge technology risk. You have to figure out if the physics or the biology actually works first. And that takes incredible patience and deeply specialized knowledge that a typical software VC just doesn't have.
Which brings us to our final section, Section 5, a new investor archetype. To bridge this massive capital gap, the entire architecture of investing must evolve. We absolutely cannot fund the fourth industrial revolution using the mental models of the third one.
Think of deep tech like a steep staircase descending into a complex labyrinth. It requires a highly methodical, escalating cycle. Design, build, test, and learn. It's a structured path to systematically eliminate extreme engineering risks one single step at a time. And this requires an investor who understands the underlying science well enough to confidently walk down those dark stairs side by side with the founders, rather than just waiting comfortably at the top for a finished, polished product to emerge.
This demands a brand new investor archetype. And notice how this beautifully mirrors Buffett's mental models, just scaled up to a massive institutional level. VCs must build their own circle of competence by hiring actual in-house PhDs and scientists. They have to extend their compounding timelines out to 10 or 15 years. They need to actively help startups cross that treacherous valley of death, that brutal phase where government grants run out, but the tech is still way too early for traditional revenue. And crucially, these investors have to recognize that since 97% of these ventures are directly targeting UN Sustainable Development Goals, patience isn't just a virtue anymore, it is a structural requirement for success.
I want to leave you with this final provocative thought. The future of human survival literally depends on funding the unknown. Right now, a full fifth of our 2050 climate goals rely on solutions that haven't even been invented yet. The capital is there, it's sitting on the sidelines, but our cognitive frameworks are lagging far behind.
So whether you're managing a personal portfolio or steering a billion-dollar venture fund, how will you redesign your own mental models to be part